Welcome to Introduction to Accounting, Preparing for a User's Perspective. Preparing and using a statement of stockholder equity. Formula for the statement of stockholder equity. The statement of stockholder equity explains how the investor's equity in a given company changed from the beginning of the year to the end of the year. It is like a financial video that shows what caused the increases and decreases in the stockholders' equity counts from one period to the next. For example, if you wanted to know whether the stockholders chose to retain the company's net income in the business or have it paid out to themselves as a dividend, you could find your answer on the statement of stockholder equity. In general, stockholders' equity has two primary accounts, capital stock and retained earnings. Although there are other factors that can influence these accounts, the basic equations we will discuss in this course are as follows. Beginning capital stock plus issuances of capital stock minus repurchases of capital stock equals ending capital stock. For retained earnings, beginning retained earnings plus net income or minus net loss minus dividends equals ending retained earnings. Increases in capital stock result from investors contributing resources to the business in exchange for ownership shares. Capital stock decreases when capital stock is repurchased from investors by the business. The beginning retained earnings balance represents all net income from the beginning of time up to the beginning of the period, less all dividends from the beginning of time up to the beginning of the period. It effectively represents all of the internally generated equity financing that the owners chose to retain in the business. When a business is profitable, its current period net income is added to the beginning retained earnings balance. When a business is unprofitable, its current period net losses are deducted from its beginning retained earnings balance. When dividends are paid out to stockholders, retained earnings decrease. You should note that the beginning capital stock and retained earnings balances come from their ending balances from the prior accounting period, because whatever you end with in one accounting period, you will start with the next accounting period. The statement of retained earnings acts as a bridge between the income statement and the balance sheet. Accountants refer to this bridging process between the financial statements as articulation. For example, if a business were to generate $5 of net income, it would also show a $5 increase in its net assets, i.e. assets less liabilities. That would be included within the balances on the balance sheet. In addition, the company would need to explain how it financed the additional $5 in net assets by showing the $5 on the income statement and then showing it increase retained earnings on the statement of retained earnings, and then including the revised ending balance of retained earnings, which now includes the new $5 of net income, on the balance sheet to balance out the $5 increase in net assets. The following represents the impact of the $5 of net income on the balance sheet. Or it can be written as net assets equals equity, where net assets are assets minus liabilities. Let's look at an example of what we can learn by reading just the statement of retained earnings portion of the larger statement of stockholder equity. Please stop the video and review these two statements to see if you can recognize which of the two businesses' owners chose to keep their net income in the business and thereby provide additional internally generated equity financing for their business. Answer: because no dividends were paid out to the owners of Business 1, they effectively chose to retain their earnings in the business. By not receiving a dividend, the owners of Business 1 effectively provided it an additional $5,000 of resources that it will be able to use to generate profits. The nice thing for the Business 1 owners is that they did not personally have to contribute the $5,000 directly from their own pockets. As a result, Business 1's net assets and its retained earnings both increased by $5,000. On the other hand, the owners of Business 2 removed all of their current year profits by receiving a $5,000 dividend, thus reducing the amount of resources the business has available to survive and expand in the future. The owners of many tech startup companies choose not to receive dividends for many years while the company is in the startup and expansion mode. For example, Microsoft was founded in 1975, but it didn't pay out its first dividend until 2003, long after it dominated the operating system market. What we have here is the stockholders' equity statements for super big tech company. This is based off of the Microsoft stockholders' equity statements, but I've changed the numbers and dates to make it more generalized for teaching purposes. The statements will always be titled, indicating name of the company, name of the statements, and the period being covered. As you can see, it's for the year ended. It's not as of, like a balance sheet would be, but for the year ended, indicating changes over a period of time. The unit of measure is in millions. That means that these numbers are not simple dollars, but rather millions of dollars. So this would be 20,434 millions. So that's actually $20 billion. Watch out for that. And you should, otherwise you would misvalue this company because these are much bigger numbers than they might appear at first glance. It's comparative. It provides 3 years of information so we can recognize trends over a period of time. Then we have the capital stock section. And as you can see, we have the beginning, we have the changes, and we have the end. We have retained earnings. This is a little different because we have another word in here called deficit. When the retained earnings account goes negative, we would call that retained deficit. And so at the beginning of this period, they were in a retained deficit position. And then over time, as they had more earnings, they came into a retained earnings position. So from retained deficit to retained earnings over that 3-year period. Then finally, we have accumulated other comprehensive income. We'll save this account for another class, but the basic idea is these are income that the company has, but it hasn't yet been earned, and so we can't put it on the income statement. So we're going to keep it here on the balance sheet to make sure the balance sheet balances, but when the income finally becomes earned, it'll go onto the income statement and pulled off of here. When you take the ending balance for each of these accounts, it adds up to the total stockholders' equity at the end of the period. One interesting thing I hope you notice in the common stock and paid in capital area is that they had a net reduction in the common stock issued and repurchased. You see this, they're repurchasing more than they're issuing. Many companies will do this when they determine that their stock on the stock market is undervalued, so they'll buy it at a low price, hold it for a period of time, and then reissue it. So that's not uncommon. Down in the retained earnings deficit section, we noticed that it was a deficit at the end of X1 and X2, but due to these additional income, it's eating away at that deficit, thus bringing it from the negative side up into the positive side. So I hope this was helpful to you in recognizing the key pieces of information on a statement of stockholders' equity. I hope you can read it a little bit to understand it. There are some things in here that we will not talk about in this particular introductory course, but you can see the basic flow of the statement of stockholders' equity, and I hope this has been helpful to you. I wish you all the best on the upcoming quiz. Aloha!